$96.2 billion. That is what Nvidia earned in revenue in a single quarter, up 106% from a year ago, and comfortably above the roughly $92 billion Wall Street expected. The stock jumped more than 4% after hours, futures turned green, and the AI trade that spent last week getting declared, quote, currently broken, woke up this morning rescued. Again. We told you Tuesday that this boom has been saved by an earnings print every time doubt showed up, and last night it happened on schedule. But here is what makes this print worth 10 minutes of your morning. The headline number is not the story. Inside the report are three quieter numbers, a margin, a payment term, and an inventory line that tell you more about where this boom actually is than the beat ever could. Today, on the current, the morning after, and what the print actually said. Quick recap if you missed Tuesday's episode. Nvidia walked into this report carrying the whole trade, about 7.8% of the entire S&P 500, the largest single weight in the index, reporting into a market that had just spent a week rehearsing its doubts. Chips sold off, money rotated into Coca-Cola and Johnson & Johnson. Texas froze new data center grid connections with 474 gigawatts in the queue. Polling showed 61% of Americans do not want a data center nearby, and Nvidia's own stock had fallen after each of its last 4 earnings reports, even though it beat estimates every single time. That was the setup, a market that had stopped rewarding good news from this company, holding its breath for one number. So the first question last night was simple. Would the machine deliver? It did. The second question is the interesting one. What did it cost to deliver it? The numbers, cleanly. Revenue, $96.2 billion against roughly $92 expected. Earnings per share, $2.22 against $2.09 expected. The engine, as always, was the data center, $89 billion, up 117% from a year ago, an all-time record for any hardware business in history. Hyperscalers, the Microsofts and Metas and Amazons, bought $49 billion of that. And the guidance, the number Wall Street actually trades on, came in at $108 billion for next quarter, plus or minus 2%, against a consensus hoping for about 104. Every box checked, every bar cleared. On the call, Jensen Huang compressed the whole company into 4 words. Now, compute is revenue, meaning the customers no longer buy chips as an experiment. They buy them the way an airline buys jet fuel. Because without them, nothing else they sell exists. That is the bull case, straight from the source. One sentence from the call did more work than the entire press release. Asked about next year, Huang said Nvidia has supply lined up for 70% revenue growth in fiscal 2028, and then added, our demand is much higher than that. Sit with what that claims. A company already selling $96 billion a quarter says it could grow another 70%, and the only thing stopping more is that factories, memory makers, and packaging plants physically cannot make parts faster. The constraint is not customers, it is atoms. If true, that kills the softest bear case, the one where hyperscalers quietly trim orders. You cannot quietly trim while begging for more supply. But notice what kind of claim it is. A statement about demand today from buyers spending borrowed money on infrastructure whose returns are still mostly promises. Supply constraints tell you the party is full. They say nothing about who pays for it. Now the 3 numbers inside the print. Number 1 is the one we flagged in our very first episode. Watch the gross margin line, not the revenue line, because margins fall before revenue does. For years, Nvidia's gross margin sat around 75%, meaning 75 cents of every hardware dollar survived as gross profit. Almost unheard of in physical products. Last night, guidance put next quarter at 74, and the quarter after bottoming around 71 to 72 before recovering next year. The reason? Memory. The high bandwidth memory wrapped around every GPU is now so scarce that prices are, in the CFO's words, rising sharply beyond what Nvidia expected. Read that carefully. The most powerful toll booth in technology is now paying tolls to someone else. The memory makers, SK Hynix, Samsung, Micron. A few points of margin on $100 billion of revenue is billions of dollars a quarter changing owners. The moat has not broken. But for the first time in this boom, it is paying rent. Number 2 hides in the balance sheet. Days sales outstanding. The time between Nvidia billing a customer and the money arriving stretched to 60 days, which the company attributes to longer payment terms for its biggest customers. Think about who holds leverage in that sentence. The largest buyers of the most supply-constrained product on Earth are getting more time to pay, not less. That is what a concentrated customer list does. They buy at your price, but on their terms. Meanwhile, inventory climbed to $32 billion, stacked deliberately ahead of the Rubin launch. Neither number is a scandal, both are choices. But together, they mean Nvidia's balance sheet is carrying more of the boom's weight. Goods built before they are sold, revenue booked before it is collected. In a normal industry, that is called extending credit to your customers. In this one, it is called Tuesday. Number 3 was not in the tables at all. It surfaced when the CFO, Colette Kress, spent part of the call defending something unusual. The mechanism arranged with the world's largest financial institutions to support up to $500 billion in AI infrastructure financing. Longtime viewers know this machine. We gave it a full episode. Loans collateralized by the GPUs themselves, bundled and sold onward, vendor and lender increasingly the same hand. When a CFO explains on an earnings call why the financing structure is sound, it is because enough serious people are asking. And stack this quarter's commitments. OpenAI's roadmap now totals roughly 12 gigawatts through 2030, including one 4.25 gigawatt campus. Amazon signed for 2 million more GPUs. The neo-cloud partners plan to nearly triple capacity to 8 gigawatts by year-end. The demand is real, signed, and enormous. So is the borrowing behind it. One more detail worth your attention. An entire superpower is missing from these numbers. Nvidia shipped almost nothing to China this quarter, less than 1% of data center revenue, and its $108 billion forecast assumes zero China compute revenue. None. 2 years ago, China was roughly a fifth of this business. Today, the biggest chip company on Earth guides as if the world's second-largest economy does not exist. Because between Washington's export rules and Beijing's retaliation, it cannot plan on a single dollar there. Hold both thoughts at once. This growth is happening with one hand tied, which is genuinely bullish if that hand ever frees. And the world's largest market for anything is being conceded by policy to homegrown competitors like Huawei, who get a protected home field to practice on. The print treats China as a rounding error. History probably will not. Now, the discipline this channel exists for, last night answered one of last week's 3 cracks, and only one. The tape crack, the fear that demand was quietly rolling over, took real damage. You do not guide to $108 billion while rationing supply if the buyers are backing away. But the Texas crack did not move. 474 gigawatts still sit in a frozen queue, and an earnings beat does not connect a single megawatt to the grid. The ballot crack did not move. 61% of Americans still tell pollsters no. And the attack ads are still running. And the bond market, where this build-out is actually financed, where 30-year yields just touched 25-year highs, opens this morning with the same trillion-dollar questions it had Monday. Earnings can rescue a trade. They cannot rezone a county, win a midterm, or lower the cost of money. Those cracks are still live. Here is a contrast worth noticing before we land. While its customers borrow hundreds of billions to buy its products, Nvidia returned a record $26 billion to shareholders this quarter. $20 billion in buybacks and $6 billion in dividends, roughly 60% of this year's free cash flow. That is what the top of a supply chain looks like. The customers issue bonds, the suppliers issue dividends. It also tells you what Nvidia thinks the best use of its own cash is. Not building factories, TSMC does that. Not buying power plants, the hyperscalers do that. The company at the center of the largest infrastructure build-out in history mostly returns its winnings to shareholders. keeping its balance sheet light while everyone downstream levers up. If you want one image of who carries risk in the machine economy, that allocation is it. Risk flows downhill, cash flows up. So where does this leave the trade? Not broken. A business growing 106% at 96 billion in scale, rationing supply is not a broken story, and pretending otherwise is as lazy as the hype. But the print moved the watch list. First, the margin line. Our oldest rule, 71 to 72, is fine if it recovers on schedule, a warning if memory costs eat the recovery. Second, the payment terms. If 60 days becomes 75, the balance sheet is financing the boom, not just riding it. Third, everything earnings cannot fix. The Texas audit, the campaign ads, the bond market's appetite for another year of trillion-dollar AI paper. The machine delivered its number, as it has every quarter of this boom. The question that decides how this era ends was never whether Nvidia can sell the chips. It is whether everyone downstream can afford what they already ordered. This is education, not financial advice, so do your own research, subscribe, and we will keep counting.